Good morning slash afternoon, depending on where you're located. Give me a minute here to get this adjusted. Thank you all so much for jumping in. My name is John Giordano. I am the AVP Director of Wholesale Lending here at Oaktree Funding. We're not going to kick off just yet. Looks like there's people still trickling in. We're still a minute early, so might have a little bit of a late start, but thank you all for your patience. Joining in on a Friday as well, so I hope everybody has some fun weekend plans coming up, or if you're relaxing, that's also usually my preference too. Just a few more minutes here. Folks are still trickling in here. just another minute or two and we'll kick off. All right. Well, thank you all for your patience. I figured it's about time to go ahead and get started. I had done a little bit of an introduction before, but for those of you who are just tuning in, my name is John Giordano. I'm an AVP Director of Wholesale Lending here at Oaktree Funding. I actually started out as an account executive, so I'm sure I've worked with some of you, or many of you are currently doing some cases too, right? The purpose of today's presentation is to be covering maximizing broker conversions through pre-qualification. What I mean by that is asking the right questions, right? We're going to be covering a lot of different questions that you can ask, but the most important thing we're going to be looking at is expectation, communication, and documentation, right? Those three things are going to be pivotal for us as we go through the process. And it might be a little bit like a broken record. You're going to be hearing that from me a lot as I'm covering each of these slides and discussing some best practices. Again, communication, expectation, and documentation, right? So without further ado, let's go ahead and kick into this. As far as it goes with content, we'll be looking at pre-qualifying conversions. We'll be also discussing the top questions that some of the better LOs in the industry are asking, right? We'll be looking at loan evaluation criteria. So as you're kind of going through the early processes, what are the certain things you need to be discussing, and what are kind of for every loan, what are the pivotal items that we need to be bringing up and making sure that we're getting information on? How do we avoid dead end deals as we're going through the process? It's important to try to catch as much as you can, but since many of you are familiar with the fact that sometimes borrowers hide things or aren't aware of certain things, and quite frankly, it can pop up at any point in the process. Let's try to avoid that as much as we can, although we're also cognizant of the fact that it could happen at any point. What are some tools for speedy approvals, right? Between the income desk, which we'll get into a little bit, or Dave 2.0, which we'll also discuss a little bit later, and any like loan origination software that you might currently be using. And then in closing, as we're covering like the process and looking at the scenario and the walkthrough, we'll make sure that we're periodically stopping and checking if there's any questions that are being asked in the chat. And I'll also end at the end for a full-on Q&A. If you have any other, resources, or even if you just want to share an opinion on something that's worked well for you in the past. So let's talk a little bit about pre-qualifying boost conversion rates, right? As far as it goes with the initial discussion, it really comes down to quality, making sure that you are efficient in identifying the issues quickly, getting them to your account executive, having that discussion, and getting the documentation. So again, communication, expectation, documentation, right? Giving the borrower proper expectations on the type of documents to collect, and then making sure the team's aware of it will make the underwriting process a little bit smoother, more than likely quicker, and then you'll more than likely get a cleaner approval that has lighter conditions and will make it easier to actually move through the process. But I think as far as it goes with documentation, something that's very common that I hear in the industry is, oh, less is more, right? I'll provide a lot less and it'll be easier to get the loan done. I don't want to provide too much. While I agree to some extent, I do think providing unnecessary documentation can delay the loan by slightly. I also think that not providing enough information is just as detrimental. There's always a happy medium and balance. That's why I always recommend communicating with your account executive to understand what the expectation is early on. So what documents at minimum are we going to be asking for? What type of issues does the borrower have? How do we identify that early? And then how do we collect the right documentation to avoid getting overconditioned for it as we go through the process? We'll also be discussing early stage deal breakers. This really goes down to expectation, and I think it comes down to a few different things. From my experience, and I'm assuming for all of you as well, there really are three different priorities that a borrower is looking for, and it could be any combination of the three. It's speed, rate, right? So one, how quickly can we actually get the loan done? Two, what is the absolute best pricing and rate that I can get on the market right now? And then three, how do we minimize closing costs as much as possible? I think it really just depends on the situation the borrower is experiencing. If they want the best rate, maybe they just want the lowest payment based on their DTI, right? If it's speed, maybe they're 15 days into a purchase contract and their COE ends in 2 weeks. They need to get this loan closed quickly, right? They're willing to take maybe a slightly higher rate if they have confidence they can get that loan done. And then finally, minimal closing costs. Maybe the assets aren't as high as we'd like them to be. So how do we look at reducing reserves potentially, or maybe even increasing the loan amounts? We reduce the cash to close that comes through, or even compensation in that case. Although I'll leave that one up to the loan officers, of course. Um, it's also important to set those expectations early, right? Discuss the process with them. I think being familiar with your lender's process is just as important as being familiar, making sure the borrower is familiar with your process. So as you're going through it, it makes you sound more like an expert and the borrower has more confidence because let's face it, we've all been halfway through a purchase before and you're getting calls from the selling agent and listing agent and you don't have visibility as to really how to get the loan done, but all you're doing is going to the borrower and just asking for more documentation, and they don't have that visibility either. So just making sure we're transparent as we go through the loan process too. And then finally, we'll be talking about optimizing the time usage. So we need to structure the pre-qualification because brokers can generally waste time with documentation and deal restructuring. That can lead to a slower pipeline. And in today's day and age where everything is quick and rates are starting to get better, it is critically important that we can close this loan quickly for you guys so you can start moving on to newer borrowers and closing other loans and of course, making the commission that we're all looking for out there. So here's some of the questions that should be asked, I think, early on in the process, right? As far as it goes for the broker profile, the first one is, what is your tax status and have you had any credit events in the last 4 years? I do think this is important even in non-QM, right? A lot of you will see tax status and think, oh, well, you don't need tax returns in non-QM. For most, if not all, alt doc programs and DSCR, you are correct. Also, if you're a full doc wage earner, you are right. We will not need to be looking at the tax returns. The only time that really pops up is if you're looking at a full doc self-employed borrower, where we'd be asking for like 1040s, K1 distributions. The other time you will see it, regardless of if they're a self-employed full doc or a wage earner full doc, is if they're collecting rental income. If they're collecting rental income and they're trying to close the loan full doc in non-QM, regardless of employment status, we will be asking for a tax return as well. Another important question to ask is under income and assets, right? Can you walk me through your income sources, deposits, and available reserves? In this day and age, more so than I would even say the mid 2000s and even in the 90s, it seems like everybody has a side hustle, right? You could have your W-2 salary job that everybody goes to on their Monday to Friday or potentially even weekends in some cases. But you could be 1099. You could be an Uber driver or doing DoorDash or Uber Eats in that case, right? Maybe you're doing it after work or on the weekends, but you're still collecting 1099 income. And as long as you have that history, it's important to bring that up and make sure you're asking that question to the borrower. So you're collecting all the income and it better identifies the program. Maybe we do need to consider a non-QM product in this case and go full doc, pair that with the 1099 income, as long as the businesses are separate, of course. As far as it goes with deposits, I think this is very important when you're looking at bank statement calculations, right? Are there any unusual deposits, like 50% over the average? Maybe each deposit for the business type is like 1,000, 2,000, and then one pops up for 70. Might want to ask the borrower for more information on that one because more than likely the lender is going to be asking for information on that one. Also with Zelle deposits or any deposits that may not look like they're related to business income and trying to identify those up front, but we'll talk a little bit more about that as we go through the presentation. And then finally, available reserves. What do the assets look like? Let's look at the most recent 2 months of personal bank statements. Do they have enough to qualify? If not, Okay, well then maybe we need to look at a gift fund for the cash to close, but we might not necessarily be able to count that for the reserves. We would still need to find some sort of verifiable asset to use in that case. And then actually looking at the scenario, what type of property are you looking at and what will it be used for? I think the property type can also determine how we're actually going to structure the loan and get it done. For instance, let's say a borrower comes to you and whether that's full doc, bank statements, 1099, P&L, what have you, the income's just showing a little bit lower, right? Can't find a way to get it done and the DTI is just too high to get the loan done. But they want to purchase an investment property and their assets look very good. Well, in that case, let's look at a DSCR product. So understanding what the property types are and how we could actually move through the process and structure or potentially restructure the loan if that pops up will make it a little bit easier and having like plan Bs as we go through the process. And then finally, the purchase contract details. So more often than not, in my discussion with loan officers, it seems like when they're reaching out to lenders and account executives, the borrower has already reached out to them to try to do pre-qualifications before they actually go under contract, right? But in some cases, they will reach out and say, I'm already under contract and I need your help. I think it's important to not only review the purchase contract, but look for any contingencies or abnormalities that could pop up. Is there additional addendums that are listed in there that may be more for the seller than it is the buyer, or vice versa? Is the property a lease to own? Because most lenders do have guidelines behind that as well, right? If it is an investment property, are the tenants staying in the property? Are they being ordered to vacate? How does that affect the actual DSCR calculation when the appraisal with market rent comes back, right? So making sure you're asking some of those questions early on and just kind of going through the discovery process. But I think at the very end of all of this, when we kind of go through all these questions, and we're going to send this webinar out afterwards, the most important thing, right when you get to that early stage, is setting a discovery call. Could be 10 minutes, could be 30. Depends on how complex the borrower's profile is, of course, as you're all aware of, but making sure you're blocking and allotting time to address any questions or concerns that could come up throughout the process. I'm going to take a quick pause here and check the chat box and see if there's any questions. Looks like we're good for now. I'll check again here in a couple of other slides, but please, if anything pops up or anything's on your mind, let us know. So let's talk a little bit more about loan evaluation criteria. We offer a wider range of products, whether that's bank statement, DSCR, or second liens that you even see on here. But if you're considering like alt-doc programs, we can also do asset depletion or utilization. We could look at profit and loss prepared by a CPA. We could also do 1099 and even in some cases just a WVOE program, right? I think for the sake of this presentation, we're going to focus specifically on second liens, bank statements, and DSCR loans. And then we're going to cover more of like a high level generic, here's what to ask for every loan, right? So for every loan, another question that could be asked is, are there any late mortgage payments on the credit report? Also, what's the borrower's employment history and type? Is there any fluctuation? Did they go from part-time to full-time? Full-time to part-time? Are there any gaps in employment within that last 2-year span? Because we do need to show at least 2 years of employment or self-employment. Also asking what the verifiable assets are. And most importantly, if they're verifiable. I have cash, it generally makes it a little bit more difficult to qualify, right? But if they have structured bank statements or any other type of asset that we're documenting, makes it a little bit easier to move forward. What's the property type and characteristics of it? Is it a 1 to 4 unit DSCR? If we're going 5 to 10, that's technically deemed commercial and you need to switch programs, and that generally leads to some different restrictions or parameters around the loan. It's a condo, great. We're going to assume warrantable, but we need to get that condo questionnaire. What type of things do we need to look at to make sure we're avoiding it becoming a non-warrantable condo? And if so, how does that limit us, right? What are the backup options? So making sure we're reviewing every type of property and the characteristics behind it, of course. And then finally, what is the borrower housing history? This is important to ask for every loan because we will ask for some general information on that. While we can't allow first-time home buyers, there are some parameters to consider with it. But most specifically, we generally see this pop up with DSCR loans. So we'll pivot up there to the top right. You'll see it as the second bullet point. Does the borrower currently own their primary residence? We generally ask for 12 months of housing history to prove this. We can also accept if they're renting, but the rent has to be stable. They've had to have been there for some time, and we also like to see it go for the foreseeable future, so at least 6 months, right? General preference is that they own their primary residence. I think this is a critically important question to ask if you're going for DSCR loans. And also, as mentioned before, what are the property characteristics? Are all of the units currently rented or are any of them vacant? What's the reason for the vacancy? We might have to apply a vacancy factor on the market rent that could affect the actual DSCR calculation, right? So getting all of the details on the property, including like square footage. If they already have an appraisal, that makes it easier, but sometimes you have to ask those questions. I think if we're looking at the actual submission of a DSCR in calculation, um, we'll always assume a 1 to start unless there's confidence that it could be lower or in some cases higher, because especially for purchases, you won't really know what you're going to get until that appraisal comes back. But I do think it's important to collect the full information to calculate the PITI, right? And for most of you who are already familiar with it, that's principal, interest, taxes, insurance, and any association fees. Taxes and insurance will do the principal and interest for you when we actually price out the scenario. But getting a tax cert and getting like that HOI, all of that information over to us, we could calculate the DSCR much more quickly at least, or know what we're up against. So if in that area, market rent seems like it's going to be a little bit lower, then maybe we pivot to a sub 1 program or have the discussion about how to restructure the DSCR to get back up to a 1, right? So collecting taxes and insurance early on is very important as we go through the process too. Looking specifically at bank statements, I think it's important to ask a number of questions. I think DSCRs, again, it really comes down to the appraisal and then making sure we can qualify based on the PITI versus the rent. For bank statements, there's a lot more that goes into it because it is a true income calculation. So what do the deposits look like? Again, are there Zelle deposits or wires? Are the wires business related? That's going to be a little bit hard to prove. Making sure that unusual deposits or anything that's large above the average is being sourced. Are there any NSFs or overdrafts? For first liens, we're pretty lenient. We allow up, I believe, to 25 or 26 in the first 12 months. For 24 would be a little bit more, of course. And then for second liens, we allow up to 12. But going through and asking how many, I mean, I think it'd be a good exercise to go through and do those tallies, but we'll get to another portion of this here in a second. What's the business type and number of employees? I think what's unique about Oaktree compared to some of the other lenders that you might see out there is we are very aggressive for first liens on the expense factors that we use. So we don't like penalizing a restaurant owner the same way we would like a self-employed work from home consultant. For service businesses with no full-time employees, we can get as low as a 15% expense factor. And as long as the big bank statements support that, and a business narrative, which is a form that we will send to the borrower, also supports that information, we will not ask for a CPA letter to get that low. And that could be the difference between like 60 DTI and 42 DTI and actually closing the file, right? So I think it's important to ask that, the business type and number of employees that are on payroll, and then looking at the bank statements, right? Are there any declines as we go through the months? If they're making a ton towards the beginning of the 12-month term and not as much towards the end and you're seeing a pretty significant decline, we're probably going to need to have that discussion too. Maybe it is seasonal, but more often than not seasonal, the price, it will be depending on the time of the year. You could either see a decline or an incline, right? But just identifying that and having that discussion with your account executive. What I've listed on the second liens is a little bit more specific for Oaktree Funding, but you'll see it amongst some other lenders out there, I'm sure, as well. The first question is there a solar lien on the property? When we're trying to move into the second position, whether that's a HE loan or a HELOC, if they have a solar lien against the property that's currently in the second position, we generally either need title or the solar company to agree to subordinate into the third position, right? It's very common. Mostly we're in Phoenix, so we see it all the time out here, even Southern California, but you could start to see it in like Texas, maybe even the Southeast regions of the United States, starting to become a lot more popular. So if they do have solar liens against their property, make sure you're having that discussion and seeing if you can work to get that subordination agreement, or bringing it up to your account executive, because again, no one likes surprises, especially the borrower. Another question to ask is the senior lien, right? If they're going to get a second lien, it usually means because they have a pretty good rate or deal or what have you on the first lien that they don't want to touch or affect. It's important to ask if that first lien is interest only. What I mean by that is generally for second liens, our max DTI is going to be 50%, but for the senior lien being interest only, that would actually limit us to 45%. And the reason we do that is because for the first 10 years, you're subtracting the principal, but then the final 20 years of that senior lien, the principal is going to get rolled back in, right? So we're going to lower the DTI maximum to account for that. Once we get into that final 20-year amortized term, the payment's going to shoot up. So making sure we're accounting for that as we go through the loan process. There's a lot of information on this slide, so I'm going to take a quick pause and check the chat, make sure we don't have any questions in here. Seems like we're good for now. So how do we avoid dead-end deals? I think some general red flags that we need to look at and try to avoid, or maybe not necessarily avoid, but address, is inconsistent documentation and getting that up front. Unrealistic expectations. It's very important that you're setting that early with the borrower and not only understanding how to get the loan done, but what their needs, whether that's the pricing, the speed, or the closing costs, or minimizing the closing costs. Maybe the property type is misaligned. Are they trying to do a DSCR, but considering moving into it within a year or two, right? That's a big red flag. Make sure you discuss that with your team. Is there any high risk credit? Maybe that's a high balance that's bringing the credit score down. Maybe they have collections or judgments or liens, 1 by 30 in the last 12 months, Chapter 13, foreclosure, what have you. Hopefully they'll tell you that, but that doesn't always happen, I'm sure, as you guys are aware. So making sure you're asking that question, or that's where the soft pull comes in, which we'll discuss here in a bit too. But let's try to rescue a deal, because as much as we can vet it up front and ask the right questions, in this business, there's always surprises, and we're going to try to catch them early. But when they pop up, we need to jump on them as quickly as possible too. So let's say that approval comes out and there's a suspension. The first thing you should do, understand what that suspension is asking for and what the reason is, and then get on a call with your account executive and how to resolve it. That makes it easier, because when you go to bring your borrower bad news, you at least have either, hey, we can't do this deal, or more importantly, you have a solution in that case, right? I think transparency with the account executive is important too. I've seen it in some cases where, oh, maybe they won't catch this, so we're just going to try to push it through, and then it gets caught. And I think both parties have spent a lot of time on the deal, and for it to die at that point is unfortunate, right? But also having backup plans, like we mentioned before. This DSCR is right at a 1. We're not sure what market rent's going to come back at, so we're going to assume a 1, but just in case we have to go with a sub 1 program, maybe there's an LTV reduction, or here's what the rate's going to look like, right? So making sure you have at least some backup plans or something in the back of your mind that maybe the borrower is aware of, or maybe you just have the structure for it. And then, of course, understanding, knowing when to close the file or when it's time to move on. The borrower is starting to get low on responsiveness or showing some general uninterest. Maybe they're not providing documentation, or they're being difficult in providing certain documentation. Usually means they're either not interested or they're potentially hiding something. If the risks outweigh the potential approval, we can work exceptions. We do them all the time. And if you've closed loans with us in the past, I'm sure you may have an exception or two loan that has gotten funded before, right? But if the exceptions start to mount up and the borrowers just doesn't really seem like they're aligning the same values that you are and the lender is, then maybe it's time to just move on and try to find a better borrower profile that we can close the loan for. Or if the deal timeline just doesn't align with the borrower or the lender needs, right? So how do we speed up approvals and improve the submissions? The first thing is having pre-qualification tools. I think amongst anything else, it's important to be able to do a soft pull on the credit report. While we only accept hard pulls, you can at least do a soft pull without affecting the borrower as much and get that information, whether there are lates or collections or liens against the borrower, or potentially any housing events that could be popping up, right? So doing a soft pull early won't affect the borrower as much, but again, it's discovery. We're trying to figure out as much as we can early on. Also, the income desk with Oaktree Funding. I think one of the biggest differences in things that I see in non-QM versus conventional is pre-qualification, right? Which is the point of this presentation, asking the right questions and qualifying your borrower. But in conventional, there's a lot of tools that are already provided where you could essentially kind of get that full-on pre-qual and then tell them to go out and start house hunting to get under contract. With bank statements, we could actually send those to our income desk to do a bank statement calculation for you. They're going to look for the NSFs. They're going to look for the declines in income or seasonal or unusual deposits, and they'll speak to those and they'll give you an income based off of the borrower's information and the expense factors that we had discussed before. So we won't necessarily calculate a DTI because it's before going into underwriting, but we will be able to give you an income figure that we could at least work with, right? So I think that's critically important too. And then, of course, knowing how to calculate a DSCR early on is important. So just in case there's any turns or switches that we need to make, we can make those and work together quickly on them. Submission checklists. I think this is a huge one. We actually have those hosted on our website. If you go to nonqmexpert.com and go to the resources tab, you should see some submission checklists listed on there. Some of them might be catered more towards like bank statements or DSCRs, but we also do have general all-encompassing submission checklists. And I think it's important not only for you guys to have those, but to discuss those with your borrower, right? Pull that up in that meeting. Here's the lenders that we normally work with, Oaktree Funding. Here's generally what they're going to be asking for through the loan process. If something is unusual with the borrower, then maybe we might have to ask for a little bit more in terms of documentation, but that's at least a general checklist of the basics of what we would be needing, right? Last but not least on here too is looking at the optional tech enhancements. So I mentioned it before, you'll know like your loan origination platform and maybe there's pricing through that, or maybe there's an easier way for you to send a 1003 for the borrower to fill out and get back to you and convert that to a 3.4 and get that to your lenders and identify those issues, right? But we also have on our side a new AI tool called Dave 2.0, and just plugging it into this presentation, it is incredibly efficient, right? It's going to scan our matrices, guidelines, look for any details within the questions that you're asking, and not only provide you an answer, but provide a confidence score. So if you see like 97 to 99 confidence in the answer, you know you could probably roll forward with it. But if it's starting to get a little bit lower or it's unsure, reach out to your account executive, reach out to the experts over at Oaktree, and we'll make sure we get you those answers too. I think one final thing I'll mention on this page before we pivot to is the expectations on turn times. Generally, each condition review cycle or underwriting review cycle, I would say is about 48 hours. Sometimes it could go up more towards 72, especially as you get towards the end of the month. We've seen some that go as low as 24 hours, depending on the time of the month as well, right? But I think it's important to look at the totality of the process and have a realistic conversation with your borrower, because I get this question all the time from loan officers. How quickly can you close the loan? It's an important question, right? But it's difficult, I think, for an account executive to answer. And my response usually is, how motivated is the borrower? Because here's our general SLAs and timelines. If the borrower has proper expectations and is getting us the documentation we're asking for quickly and moving through, then sure, we could close a loan in 3 to 4 weeks, no problem, right? But I've closed some loans in 10 days and I've closed some much longer than that because of the unrealistic expectations, lack of communication, lack of proper documentation, and a number of exceptions that pop up throughout the process because we weren't given that information early on. Talking a little bit about a live scenario workshop process. I think just covering roughly what a submission looks like with Oaktree Funding. So you are aware and the borrower is aware, right? First and foremost is that discovery. So you're going to ask these questions. You're going to gather all the documentation. Again, communication and documentation in this case, and then expectation. Once you gather all that, you're going to work with your account executive to submit that scenario and make sure the account executive is aware of any potential snags or hazards that are popping up throughout the process. Once that scenario is submitted and we get into disclosures and they're sent and signed and then doc check, so setup has everything they need, they're going to send it to the underwriter. Underwriter is going to review in around, I would say the average is 48 hours. And then once that comes back out with an approval, hopefully based off of all of the discovery and questions and upfront work that we're doing, we're going to have a lighter list of conditions, right? We know what we're looking for. Conditions come back. We have our marching orders. We're going to go ahead and work on getting that done with the borrower. From here, you could look at locking the loan, ordering the appraisal. Either way, we're going to need both of those, as well as like credit invoices and appraisal invoices to start working a CD as we get towards the end of the process. And then once that process actually ends and we have the CD, all of the conditions are met, then we will go ahead and CTC the file and proceed with closing. And I know that's everybody's favorite part of the process too, right? Is getting that loan funded and making sure we're moving on to the next one. So all in all, as mentioned, I would say the process is roughly 3 to 4 weeks with borrowers who have the proper expectation, are properly communicating, and getting us the right documentation. Now, wrapping up, I would say it's critically important to be more efficient now than ever before, right? In this day and age where everything is needed quickly, but we also have various platforms and tools to make us quicker. And with rates slowly decreasing over time and borrower interest in purchasing investment properties and DSCRs and second liens to get equity to go do so, right? I think it's critically important to have that process ironed out, and when your borrower has the right expectation and you're communicating and we have the right documentation, we can close these loans quickly and efficiently and then give you time to go work on the next one. Right. So thank you guys so much for the, jumping into this presentation. I'm going to stay on and see if there's any questions listed in here as well. We're going to be sending this out after the fact as a full recording, and we'll be adding a flyer showcasing some of our important and up-to-date highlights. But never hesitate to reach out. Please reach out to your account executive. We're always rolling out brand new and exciting programs, and we want to make sure you guys can be a part of the journey with us. I'll hang tight for any questions. I haven't seen any in the chat yet, but if you want to shout them out, go ahead and jump off mute. Yes, absolutely. Sorry if I didn't see that before, but you will go to nonqmexpert.com and then you will go to the resources tab. And if you're joining into this webinar and you're not sure who to work with over here at Oaktree, I'll provide my contact information, but also you could reach out to marketing@oaktreefunding.com. Like I said, I'm an AVP director of wholesale lending, so I'll at least put you in touch with the right account executive or get you connected to somebody too. No, I don't know if I'm seeing any new ones in here. Well, I'm not seeing anything new in here, so we can go ahead and wrap up. If you do have some questions you would like to ask or get a hold of your account executive, please reach out to our marketing team or myself, and we can get you in touch with the right people. Otherwise, again, thank you so much for your time today, and have a great weekend.